How safe is Verizon Communications dividend? On August 1st, 2019, Verizon Communications reported second quarter earnings results for the period ending June 30th, 2019. This video provides an update on the company's dividend safety using its most recent operating results. Before we begin, I invite you to subscribe to our channel and like this video, which will help more people discover Sure Dividend's investor education efforts. With that out of the way, let's dig into Verizon's dividend safety. To begin, let's talk about Verizon's business model. Verizon was created by a merger between Bell Atlantic Corporation and GTE Corporation in June of 2000. The company is the largest wireless telephone carrier in the U.S., covering nearly 300 million people and 98% of the country. Verizon also offers broadband and cable services. Verizon has a market capitalization of $229 billion, with annual revenues of $130 billion. Verizon is one of the world's most popular dividend growth stocks. The company's current dividend yield is nearly 4.4%. Moreover, Verizon is a consistent dividend grower. In fact, the company has increased its annual dividend payment for 14 consecutive years. Despite this market streak, Verizon is not yet a member of the Dividend Aristocrats, a group of exclusive dividend stocks with 25-plus years of consecutive dividend increases. For the remainder of this video, we will discuss Verizon's dividend safety from four perspectives: its dividend safety in the context of its current earnings, its dividend safety in the context of its current free cash flow, its dividend safety in the context of its recession performance, and its dividend safety in the context of its current debt load. The Verizon's dividend safety relative to earnings. First, let's discuss Verizon's dividend safety in the context of the company's current earnings. In the second quarter of fiscal 2019, Verizon generated adjusted earnings per share of $1.23, which compared favorably to the $1.20 of adjusted earnings per share in the same period a year ago. For context, Verizon currently pays a quarterly dividend of 60.25 cents per share, which implies a payout ratio of 49% in the most recent quarter. Looking out over a longer time horizon, our conclusion is the same. Verizon generated $2.43 of adjusted earnings per share in the first half of fiscal 2019. The company distributed $1.20 of common share dividends during the same time period for a dividend payout ratio of 50% in the full fiscal year. Using earnings, Verizon's dividend appears very safe for the foreseeable future. Verizon's dividend safety relative to free cash flow. Many analysts believe that comparing a company's dividend payments to its free cash flow is a better method for assessing dividend safety. Accordingly, we will now compare Verizon's current dividend payment to its free cash flow. Verizon generated $8.8 billion of cash flow from operating activities in the second quarter of fiscal 2019 and spent $3.7 billion on capital expenditures during the same time period for free cash flow of approximately $5.1 billion. The company distributed $2.5 billion of common share dividends during the same time period for a free cash flow dividend payout ratio of 49%. Looking out over a longer time horizon, the company's payout ratio is higher, but still considered safe. Verizon generated $15.8 billion of cash flow from operating activities in the first half of fiscal 2019 and spent $8 billion on capital expenditures for free cash flow of approximately $7.9 billion. The company distributed $5 billion of common share dividends during the same time period for a free cash flow dividend payout ratio of 63%. Using free cash flow, our conclusion for Verizon's dividend safety is the same as when we used earnings. The company's dividend is currently well covered by free cash flow, and we see no risk of a dividend cut in the near future. Verizon's dividend safety relative to recession performance. Companies do not cut their dividends in the good times. Instead, dividends are reduced when companies experience financial difficulties. Accordingly, this section will analyze Verizon's current dividend safety in the context of the company's historical recession performance. We believe that the best way to measure a company's recession resiliency is by measuring its earnings per share performance during the financial crisis that occurred between 2007 and 2009. Verizon's performance during this time period is shown here. 2007, adjusted earnings per share $2.34. 2008, adjusted earnings per share $2.54. 2009, adjusted earnings per share $2.40. 2010, adjusted earnings per share $2.21. 2011, adjusted earnings per share $2.15. 2012, adjusted earnings per share $2.32. 2013, adjusted earnings per share $4. Despite a decline in 2009, Verizon produced a 2.6% increase in adjusted earnings per share during the last recession. The company did not make a new high in adjusted earnings per share until 2013. More importantly, the company's earnings still covered its dividend payment, and Verizon continued its streak of dividend increases. Because of this, we have little concerns about the company's ability to pay rising dividends during future economic downturns. Verizon's dividend safety relative to its current debt load. The last angle that we will use to assess Verizon's current dividend safety is by looking at the company's current debt level, which is a cause of concern for many investors. More specifically, we will see how much the company's weighted average interest would have to increase before its free cash flow would no longer cover its dividend payment. At the end of the second quarter of fiscal 2019, Verizon had $113.3 billion of total debt outstanding. The company generated $1.2 billion in interest expense in the most recent quarter for a weighted average interest rate of 4.2%. The following image shows how changes to Verizon's weighted average interest rate would impact the company's dividend safety as measured by free cash flow. As you can see, Verizon's weighted average interest rate would need to rise above the 8.8% level before its dividend would no longer be covered by free cash flow. Because of this, we have little concerns about the impact of the company's debt on Verizon's dividend safety moving forward. Looking out over a longer time horizon, the dividend appears even safer. Verizon generated $2.4 billion in interest expense over the first half of fiscal 2019 for a weighted average interest rate of 4.2%. The following image shows how changes to Verizon's weighted average interest rate would impact the company's dividend safety as measured by free cash flow. As you can see, Verizon's weighted average interest rate would need to rise above the 9.3% level before its dividend would no longer be covered by free cash flow. Because of this, we have little concerns about the impact of the company's debt on Verizon's dividend safety moving forward. In conclusion, thank you for watching today's video, which performed a deep dive on Verizon's current dividend safety. We invite you to subscribe to this channel and like this video, which will help more people discover Sure Dividend's investor education efforts. If you're interested in learning more about our systematic approach to dividend growth investing, visit our website, suredividend.com.